Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to go over a few breadth readings. The market is doing well overall. Apple, Nvidia, Microsoft, Google, and today Broadcom have hit new highs. So the market is doing well. The indexes have done well. S&P, NASDAQ have hit new highs recently. But beneath the surface, breadth still isn't very good. It certainly isn't supportive. This has been the case for a little bit of time. So just want to go through these to get an idea of what is going on beneath the surface. All right, so first up, this is the S&P 500. It's the weekly chart going back about 5 years. Let me draw a few trend lines here. So we got the COVID low over here in March of 2020. Nice rally that lasted nearly 2 years. Then we have a big cup and handle pattern here. Neckline resistance there, breaks out. Obviously you can see rallies up, comes down, tests its 21, and then rallies up again. So it has hit a new high numerous weeks in a row. New high this week, last week, the week before didn't, but the week before that, the week before that. So markets, it's strong, it's healthy, it's trending up. This is a great pattern here, measures much higher, and then if you use the move into the pattern, it measures even higher from there. So everything looks good on the surface. S&P looks good, NASDAQ looks good. Small caps, mid caps are lagging a little bit, but all the big and important companies, or most of the big and important companies, are in the S&P and NASDAQ. So our bias has to, long term, our bias has to be to the upside. Certainly you can get a pullback here to the 21 again. Certainly you can get some, let me delete those. Certainly you can get some sideways movement here. Anything goes day to day, week to week, but overall the bias definitely should be to the upside. Okay, but when we look beneath the surface, let's check out what breadth is doing. So here's the S&P 500 versus the NYSE AD line. Okay, tops and bottoms between the index and the indicator match up pretty closely. You can see top here, very close with the top here, bottom here, matches up with the bottom there, top here, matches up at the top here. You can go a little, line by line, day by day, and these match up very well. So it's very telling that right now we have a pretty big divergence in place. Okay, going back to the second week of May. Higher high here from the S&P, lower highs from the AD line. That means even though the S&P 500 has been pushing higher over here practically day after day after day, decliners have overall outnumbered advancers. Okay, so market's moving up, but more stocks are falling than advancing. Okay, so that's a warning. Okay, on the surface things are doing well. Beneath the surface, less stocks are participating. Next indicator, this is the S&P 500 up top, and it is the 1 month high-low down below. Okay, so the high-low is how many stocks are hitting a 1 month high versus a 1 month low. 1 month is a pretty good time frame. If you use a 52-week high-low, sometimes that could be a little bit too far out. Use a 5-day high-low, which I still look at. Sometimes that's a little bit too close. A 1 month is a good time frame. And so we have a divergence in place, same as the AD line. We have higher highs here. We have lower highs here. But also look over here is that we have, other than yesterday, we had one single print right there that was above zero, and today it's already back below zero at minus 196. Going back to all the way over here, which is basically the middle of May, maybe the third week of May, every single print has been below zero. So even though the market has generally done pretty well, the S&P has hit a new high, new all-time high numerous times. As I said, Apple, Nvidia, Microsoft, Google, today Broadcom, all hitting all-time highs. Day after day after day, you had more stocks printing a 1 month low versus a 1 month high. So the market's going up, but you have a lot more stocks falling than coming along for the ride. So this is a negative divergence. It usually doesn't, the market doesn't have to top permanently, we're going to have a bear market. It doesn't mean we're going to crash. It just means that it's getting thin beneath the surface, and we probably need to at the very least move sideways for a few weeks to digest the gains, or correct a little bit, do some, shake the tree a little bit and shake out the dead wood, and then build a little bit of a base and go up again. Okay, but the market just can't go up too much and for too long when you have more stocks dropping than rallying. All right, next one, last chart. This is the S&P 500 up top. Down below is the percentage of Russell 3000 stocks above their 20-day moving average. Okay, so in the last chart, we used a 1-month high-low, which is about 21 days. Now we're using the 20-day moving average, so it covers about the same time frame. Okay, I prefer it over, say, the 50. I still look at the 50, and I still look at the 5 to see what like shorter and longer term look like. But I like the 20 because it's in the middle and it fits my my time frame as far as my holding time as far for trading. So we have the same type of divergence forming: market higher high, indicator lower high, a very obvious lower high, and you can see going back 2 to 3 weeks, every single print has been below 40%, not even below 50%, but below 40%. So over here, S&P moving up and up and up. It's above every single moving average, every single look back period. It can't get any better than that. And yet you have 60% of stocks are below their 20-day moving average. Okay, so as the market has gone up, you can see it went up. Let me delete these. So when the market went up over here, you had like 75% of stocks above their 20-day moving average. Then we got a little correction here, but there was a huge correction here. Okay, a small move down over here resulted in a big move down over there. Then the market resumes its uptrend, goes up and up and up. Most days it goes up, printing new highs day after day, and yet very few stock, but all these stocks that lost their moving average over here didn't recover. Okay, so this is a pretty obvious and major divergence. The market needs to rest. It needs to digest its gains. You can get something like this where the market just moves sideways for several weeks and allows the indicator to cycle down and then establish a base, then move up. Or you can actually get a little bit bigger of a pullback like this, which is what happened over here. Okay, but either way, the market looks good on the surface. It's strong, it's healthy, it's moving up, et cetera, et cetera, et cetera. We see all that stuff because the big cap tech names are doing really well and they're the ones that dominate the indexes. But beneath the surface, advanced decline line moving down, stocks at a 1-month high-low, below zero, favoring the 1-month lows, and then stocks above their 20-day moving average moving down too. So something's got to give here. The market's in great shape. It's built itself up a lot of goodwill. Whatever dip we get is probably going to get bought. I'm pretty confident of that. But I think we got to be a little bit careful about chasing things higher because the support just isn't there. All right, we'll see you next time.